respected, respected star member, and other professional colleagues. Today, it is the first webinar of the society, and we have eminent speaker Siri CA Gaurav Gupta ji and Advocate Jaspal Singh ji. They will update us on the latest subjects on service tax and GST by CA Gaurav Gupta ji, and latest update on income tax by Advocate Jaspal Singh ji. All of us will learn a lot from this webinar, and all the star member are anybody, and if any star member is willing to give any query, please mail us on query at the rate taxeducation.in. I repeat, query may kindly be sent at query at the rate taxeducation.in. Now, without waste of any further time, I request the first speaker of the webinar, CA Gaurav Gupta ji, for latest update on service tax and GST. Gaurav ji, please.
Thank you, Sureshji. Uh, Indeed, this was a very happening month for GST and service tax. We thought that since GST is around the corner and service tax is around the corner, we thought that
Sorry for the inconvenience caused due to the technical problem of connectivity. Now over to Gauravji for deliberation.
So, whenever we will speak about service tax or GST, the problems are bound to happen without choice. So, let me just take you back. I was speaking about the first major relief which has been provided by the government in terms of issuing the instruction number 137 by 155 oblique 2012 service tax part 1 dated 9th of December 2016, whereby the government has given a relief to the SSC by mandating or by instructing the officers that the past assessments may not be reopened only because there has been some increase, some substantial increase in the turnover of a person during the recent month. And why that turnover has been increased, we all understand that demonetization was effected on 8th of November 2016, and thereafter the digitized economy in terms of payment has increased many folds. So there were many turnovers which government also has accepted that will come into the formal channel of the economy, and therefore there can be variations in the turnover which were there shown by the people last year and this year. So merely on the count of turnover, if there is an increase in turnover, the past assessments of such people in indirect taxes will not be opened, particularly service tax. The second change, which again it is a relief uh, for the payments made through digital mode. We make payments through credit card, debit cards, or other digital modes. Usually, when banks you give you a credit card or a debit card, sometimes with some of the banks or most of the banks, I would say, they charge a fee from the vendor. On that particular fees, the vendor is also supposed to pay the service tax. So, wide notification number 52 by 2016, dated 8th of December 2016, exemption has been given to all payments which are below 2000 per transaction. No service tax shall be levied on the charges levied by the acquiring bank on such transaction. I repeat, there has been some major confusion. I had been getting constant queries that whether if I make a digitized payment, whether service tax is exempted on that digitized payment which is made below rupees 2000 or the charges. Sir, we make it very clear, the exemption is not to the services which are received below 2000 rupees. So for example, I have gone to a saloon and I have taken a haircut or whatever, and the total charges, it comes to around say 1500 rupees. Service tax shall be charged by the saloon on 1500 rupees for its services of haircut and etc. No exemption is available to such charges. What will be when I'll make the payment by a digital card? Then vendor would be charged a fee by the acquiring bank. On that particular fees, whatever service tax will be there, since the transaction value is less than 2000, those particular service tax on such charges by the acquiring bank will be exempted. So this is again a relief to promote the digital economy in the country. Again, on 19th of December 2016, another notification number 53 by 2016 was issued in service tax, whereby government has given relief to the online database or access retrieval services, which has the scope of which has been expanded in the last month, and a lot of services which were web-based, cloud-based services, which were added on the definition of online database and access retrieval services. Any person who was providing such services, he has been given a relief and exemption to put his digital signatures on the digital invoices issued by such person up to 31st of January 2017. So such person is required to pay service tax now in India, even though he do not have a presence in India. So in case he is giving services to a person who is a business entity, then under the reverse charge, such business entity is supposed to discharge the service tax liability. But when such person is giving services to a person who is not a business entity in that particular case, the person who is the service provider is now required in India to get registration and to discharge his service tax liability. Accordingly, since he is also issuing invoices digitally, it should be signed. Now, that physical signature or digital signature is mandatory. Therefore, to give him a relief to some extent, up to 31st of January 2017, he has been given an exemption so that he can gear up his systems, and thereafter he can issue the invoices using a digital signature. Then again, 12th of January 2017, very recently, the government has issued four notifications. The first notification has been issued, notification number 1 by 2017. Again, a major change which has been brought on. We have an exemption in mega exemption number 25 by 2012, notification number 25 by 2012, dated 20th of June 2012, whereby in entry number 34, two exemptions are there. Number one, when an individual he receives certain services from outside India, those services have been exempted from service tax in past. Similarly, when a non-resident gives a service to another non-resident, there is no person in India who is receiving such services. Those services are also exempted by notification number 25 by 2012, entry number 34. Now, this particular entry has been amended by the notification number 1 by 2017, whereby the government has cut short the exemption by two parts. One, the services of online database or access retrieval services when received by an individual has no longer been made exempted. The exemption has been taken off. And second thing, this exemption will be taken off not from the date of this notification, which is 12th Jan, but from a future date. They have given time till 22nd Jan 2017. So any such services when they are received by an individual, the exemption is no longer available, and therefore the service provider will now be discharging the service tax liability with effect from 22nd of Jan 2017. The second major change which has been brought on, and which is again having big implication, we have seen that on 1st of June 2016, the ocean freight was made taxable by its removal from the negative list. The transportation by an airlines is still finding a space in the exemption notification, but any transportation by a vessel from a place outside India to the first custom stations in India is taxable from 1st of June 2016. So all the shipping lines who were, or all the freight forwarders who were there in India, they were charging service tax from 1st of June 2016 to their customers when they are issuing an invoice for freight from outside India to the first customs station in India. And in case a person in India is obtaining such services from a shipping line which is located outside India, then such person is supposed to pay service tax under reverse charge. The question of dual liability, because this particular freight was also forming part of the valuation which is used for the purpose of discharge of customs duty. Now there was a dual levy on the same value, so that value is used for payment of customs duty also, and that ocean freight is now exigible to service tax also. So that debate has been there on. We are not discussing that debate per se, but as an extension to that particular levy, very recently in 20, by the notification number 1 by 2017, government has also taken off the exemption when such services of ocean freight from a place outside India to a place first custom station in India is provided by a non-resident to another non-resident. Now, this is a bit surprising, but why it has been done so? Because in such cases, the place of supply is falling in the taxable territory, and therefore these services become taxable. Now, the question arises, who will discharge the service tax in this case? Because both the entities, the service receiver and the service provider, are located outside India. In terms of discharge of the liability, again, government has come out with notification number 2 by 2017. again dated 12th of January 2017, whereby it has been said that in such cases, the tax shall be discharged by the person who complies with section 29, 30, 38, read with section 148 of the Customs Act. And I repeat, the tax is to be discharged, service tax on such freight is to be discharged by the person who complies with section 29, 30, 38, read with section 148 of the Customs Act. Now, interestingly, again, the levy, the dual levy, is expanded, and when the service provider and recipient of such services are outside India, they have made a shipment to a person in India. The person in India who is supposed to get that goods cleared is also made liable to discharge the service tax liability in such cases. So, as a major change, it's a very big change for the travel industry, to our operators, I would say. Notification number 4 by 2017, again dated 12th of Jan 2017. The services by a tour operator, the abatement on that particular services has been reduced, and the taxable part of that particular service has been increased to 60%. The conditions have also been amended, so every tour operator is now supposed to pay 60% on his services. The conditions have been amended. Now he will not be allowed to take standard credit on inputs and capital goods used for providing taxable services, and the condition of standard credit on input services has been taken off. So that particular piece is no longer there. Input and capital goods only are restricted in terms of standard credit henceforth. However, the bill issued for this purpose should indicate that it is inclusive of charges of accommodation and transportation required for such a tour, and the amount charged in the bill is the gross amount charged for such tour, including the charges of accommodation and transportation for such a tour. So that particular invoice should include all the charges, and no separate charges in terms of accommodation or transportation should be done by the tour operator. Then the entire credit of input services available and the rate of tax which this tour operator will now be charging would be 60% on his invoice. This particular notification shall also will also come into force from January 22nd, 2017, and not from the date of this notification, which is 12th of Jan 2017. So we have got couple of odd 8 days to gear up for this particular change in terms of our invoices, in terms of our reporting system. But since this change is coming in middle of a month, I think very categorically we have to take care that we are discharging service tax properly, as the rate change will happen in the middle of the month. So tour operators, I think they need to be very cautious about this particular change which is there in the rate of their liability. There had been some very interesting decisions from Supreme Court and Honorable Supreme Court and Honorable High Courts in service tax regime in the last 1 month. I would share two, three judgments which were very material for all the assessors, I would say. The first decision of Honorable Supreme Court I would like to discuss is Gujarat State Fertilizer and Chemicals Limited versus Commissioner of Central Excise. The citation is 2016 76 taxman.com 357. Now, in this particular case, the question was that both the entities, there were two entities, GSFC and GACL, they have set up, invested into a common infrastructure, and they were also sharing the cost of that operation of that particular common infrastructure. So there was some gas which was coming through pipeline, and the cost of operation of such infrastructure was shared between the two entities. However, what happens is, the since the infrastructure costs are being paid by one entity, the other was paying its share to such entity. Service tax department contended or wanted to charge service tax on the amount which is paid by the latter entity to the former entity. The question, I think, has been very common, and in terms of cost sharing, a lot of cost sharing is being done by many of the companies. There are primarily two questions which come up. Now, this is again in the period when there was a specific category of services. In such cases, usually the arrangement should be pre-decided in the sense that the services should be identified that yes, it belongs to both the entities which are there, and both the entities own the cost at the inception. So it is not so that I have the primary privity of the contract to such services, and then out of that I am sharing something with the other person. That has also been the facts of the present case. So when such a responsibility or when such a liability at the inception is a privity of both the parties, then merely when the payment is being made by one party and the cost is being shared by the other party, the cross charge which is paid by the other party would not be exigible to service tax. I would read out the specific observation of Honorable Supreme Court in the matter. Once these facts are accepted, we find that the handling portion and maintenance, including incineration facility, is in the nature of joint venture between two of them, and the parties have simply agreed to share the expenditure. So there is no element of service per se by one entity to another entity when the cost sharing agreement is in place properly. So this is again a very important decision which will give a lot of relief to a lot of assessees who have been into cost sharing arrangements with their group companies or with their associates, and such cost sharing is known to both the parties since beginning. Now, again, Honorable Supreme Court in the decision of State of Rajasthan versus Union of India 2016, 75 taxman.com 10, Supreme Court has laid down another very important decision where it is saying when there is a already alternate remedy which has been initiated by the SSC, the filing of the writ and going for any other civil suit shall not be acceptable. So this particular decision actually focuses on the fact that when you have gone into the appellate proceedings and you're following the there's a alternate mechanism, filing of civil suits should not be allowed, because that alternate mechanism will reach the conclusion sometime or the later in the normal courses, and duplicacy of the proceedings should be avoided on the part of the assessee. So this one decision, and there's a matter related to actually the provision of the police forces to banks and other things on which service tax authorities are wanting to levy service tax. However, as a part of their statutory obligation, the police authorities are contesting that they are not exigible to service tax. Again, this again third decision is again from Honorable Supreme Court in the case of N. Balabaskar versus Union of India. We all know that indirect tax is a tax which is on the consumer. It is collected by the provider and deposited with the government. So the bearing or the tax is borne by the consumer of the goods or services. That is what indirect taxes is all about. However, so we were under the understanding that yes, the consumer, since he is bearing the taxes, he can approach to the authorities. He can approach to the courts because he has been the person who has actually paid taxes to the government. However, in this particular case, Honorable Supreme Court has observed that uh, this particular suit was filed by a consumer. The special leave petition was dismissed by Honorable Supreme Court on the ground that see there, if all the assesses, all the taxpayers, I would say rather, who are individual taxpayer consuming services or goods and then paying to the provider of the goods or services, if they are allowed to approach the authorities directly, it would lead to a mammoth exercise in the country, because this will lead to many taxpayers coming to the forums directly and asking for the relief, and which is not actually the manner indirect taxes has been structured. Because what we call the persons who are collecting the indirect taxes and paying to the government, It is basically an extended jurisdiction whereby such persons are made responsible. So, in case there is any grievance, or in case there is any excess payment or short payment of taxes, only the person who is a taxpayer, who is the person who is providing such goods or services which are taxable in indirect taxes, is made liable and can interact with the government and put forth all the contentions before the government or the courts for excess or short payment of taxes. And accordingly, only these people can approach the various authorities. So honorable Supreme Court has actually, given relief to the revenue side, that no, such individuals who are consuming the services or goods may not be approaching the authorities directly for any sort of relief, any sort of contest. Let it be from the persons who are made responsible for collecting the taxes by the government. A big relief to the SSCs by Bombay High Court in the case of Jindal Drugs Private Limited versus Union of India. The decision is not which is for the first time, but I think again and again quoting the same thing, which is a relief to the SSCs, is actually looked forward by the SSCs time and again. The Honorable Bombay High Court has said that if the refund is claimed originally by the SSC and is complete in all respects, and if it is not granted within 3 months therefrom, then assessee is entitled to interest on belated refund. And authorities are supposed to. So, if the authorities have called in for reworking of the refund piece or any other workings on the from the assessee, this will not mean that the refund application per se has been incomplete or is refiled by the assessee. Such things are only procedural. The substantial claim has already been put forth before the department by the assessee, and therefore, in case there is a delay in terms of payment of such refund by the authority to the assessee, the authority is bound to pay the interest also to the assessee. Again, Article 366(29)(a) of the Constitution of India, uh, supply of food for human consumption has been deemed to be a sale in the said article of the Constitution. Now, when this particular item is being discussed, we primarily discuss the restaurant services. What happens in restaurant services? A person goes to a restaurant, he orders food which is being served, he enjoys the ambience, and if any other unique features like um, live music or something like that is provided, air conditioning is provided, there is a mix of services. And also when the food is served, he consumes a food which is a goods which is prepared by the restaurant. So there is a mix of both goods and services, and the main portion is there is a supply of food for human consumption. So the underlining factor is a service, and during that supply the food is also being consumed by that particular individual. Now article 366(29)(a) of the Constitution deems it to be a sale. Now, when it is a sale, parallelly service tax has also come out with the levy of service tax, because underlining the facility is a service, the air conditioning, the service, the live music, or whatever there is in the restaurant. And the service tax authorities has also given an abatement. I would say the valuation has been identified by them under under Rule 2C of determination of value rules, whereby 40% of the total value of the bill is determined towards services, and service tax is levied thereon. Now, the assessee in this case, which is Kerala Classified Hotels and Resorts Association, they have gone to the High Court, um, claiming that since it is a deemed sale under the Constitution, no service tax should be levied on such transactions. So, service tax should not be allowed to be levied on restaurant services. That was the whole gist of this particular decision. Honorable High Court of Kerala has reaffirmed, I would say, its position, which it has already taken in its earlier decision in Kerala, again, Union of India versus Kerala Classified Hotels and Resort Association, 2014 4 KLT SN 68. Division bench has confirmed that particular decision, and this particular decision, again 2016, 75taxman.com, 272, Kerala High Court, again says the same thing, that service tax is not leviable on restaurant services as it is a complete deemed sale under the constitutional article 36629A. So the matter is pending before Supreme Court, but it has also been observed that since Honorable Supreme Court has not given any stay in the particular matter, therefore the present law which is there, the relief is to be given to the SSE, and restaurant will not be liable to pay service tax. So that is a position which is prevalent in Kerala, and it is a decision of Kerala High Court. We are waiting for similar decision, similar relief from other high courts, and I think a consolidated decision or position be taken throughout India, and let that case be filed before Honorable Supreme Court on a consolidated manner. I'm speaking in line, what happened in renting also. Renting, number of cases, Home Retail Solution in Delhi High Court, Retailer Association in Bombay High Court, then again Punjab, Haryana, Gujarat. All of them have given different, verdicts about renting. The appeal is right now pending before Honorable Supreme Court. Supreme Court has ordered that all assessees will be liable to pay service tax on renting till the matter is, settled or decided by the Honorable Supreme Court. And meanwhile, it is a one single consolidated throughout the country position which is pending before Honorable Supreme Court. Now, in this particular matter also, it would be advisable if such an instruction or if such an order is made by the Honorable Supreme Court, so that the assessees throughout India, they are very clear that yes, whether do we need to pay service tax on the restaurant services or do we not. The problem with indirect taxes is if the person who is providing the restaurant services, he fails to collect such taxes from his customer, tomorrow if it goes against him, he will not be able to collect, the service tax from all his customers to whom he has provided the services in last 2 3 or 4 years, whenever the decision is there. So a concrete position in this particular arena, I think, is much required. It should not be left in dilemma between the SSE. Otherwise, a lot of liability can come out tomorrow on small restaurants or other, persons who are into the same line, on account of the understanding which has been gathered from this particular decision. So this was all about service tax. I will now take up some very recent updates in GST, goods and services tax, which is actually the tax which we are looking forward to, and we are hoping that it will be in India from April 1, 2017. It will change the entire indirect tax regime in India. Um, Going forward, GST would subsume all the major indirect taxes in India. On the central levies piece, when we speak, it will primarily subsume the central sale tax, the excise duty, and the service tax. And on the state piece, when we speak, it will majorly be subsuming the VAT, the value added tax, which was earlier known as sale tax, the entertainment tax, the luxury tax, the entry tax, and so on, all these kinds of taxes which are levied on the supply of goods and or services. The terms provision of services, sale of goods, manufacture, they again will become, the items of past. We are looking forward that we'll be having only one terminology. All the manufacturers, traders, and the service providers, they will be only known with the name supplier. And going forward, we only have one point of levy, which is supply of goods and or services. So I am not going into the intricacies or the law of GST per se, but what has happened in the past 1 month in GST, I am sharing that with the August House. So GST Council is the primary body which has been constituted under the Constitution of India to take decisions or consensus on all the major decisions of the GST law. The reason is that that particular body should, have an approach or should ensure that GST law is consistent throughout India, and we will not be sitting on multiple laws. See, GST, we will be having one CGST law, 31 SGST law, and one IGST law. When we speak about 31 SGST law, Delhi GST law, Gujarat GST law, Chhattisgarh GST law, all each of the state will be passing its own GST legislature, because this is a dual legislature where both center and state, they share the domain of levying the tax on the supply of goods and services. So all in all, we are speaking about 33 taxes tomorrow, which will be there, acts which will be there under the GST tomorrow. So this GST council is ensuring that there is a uniformity all across in terms of these laws, and we are not sitting on 33 different laws. Otherwise, the whole purpose of that uniform one nation, uniform tax may get diluted. Now, we have had 5 meetings in past before December. We had the sixth meeting of the GST Council on 11th of December 2016. No major issues were sorted out in this particular meeting, uh, because dual control issue became a major showstopper in this particular meeting. The debate between both the center and the state, that who shall be controlling which SSCs. The earlier, settlement between both of them, as was known, was basically that the center would be looking after the assessees, or will be administering the assessees who are service tax assessees, and primarily, and states would be administering those assessees exclusively which are having a turnover less than 1.5 cr, 150 lakhs, and also the assessees, where they had been handling in the past. The major issue which came was on count of service assesses, because tomorrow many of the supplies, which includes both the supply of goods and services of, for example, works contract, construction, for that matter, supply of food in the restaurants, catering services, right to use even, has been deemed to be a service. So all the assessees who would be supplying these kinds of mixed bags of goods and services are deemed to be supplying only services, and therefore it was understood that if the domain of service assessees goes to central government, these all assessees would be administered exclusively by central government. So there were objections from many states, and in line the issue was not sorted out, and the issue is still pending before the GST Council. We hope that this issue may be sorted out soon. Then the next meeting, seventh meeting, happened on 22nd and 23rd of December 2016, where gladly most of the provisions of the GST laws were accepted by the GST Council. However, it is very pertinent to note that today in India we have two issues of the model GST law. However, the first model GST law, the draft law, which was issued in June 2016, was by the Empowered Committee. Then GST Council was constituted. We hope that GST Council would come out with the law. However, in November 2016, again the law which has been issued in public domain, the draft model GST law, was not by the GST Council but by the GST Secretariat. So again, there is not one law in the country, model GST law, on which we have a consensus of both center and states. So we, are awaiting that GST Council will soon, in coming meetings, may provide us with the draft model GST law, and therefore the laws which are there are by the GST Secretariat as present at present. On Jan 3rd and 4th, 2017, eighth meeting of GST Council was held. It was a meeting, again the issue of dual control was not sorted out, and again the act was not issued. The model draft law of the GST was not issued by the GST Council. However, there had been some representative meetings with the representatives from various industries, including IT, telecom, banking, etc., by the GST councils, and their concerns had been well taken by the GST Council for the formulation and conclusion of the model GST law. So interestingly, the last month had been very action driven in terms of the transition or the migration of the existing assessees to GST. So a lot of big drive was undertaken in the entire country, where all the VAT authorities of different states, they had issued the provisional number through GST, and of course to their own VAT dealers and on their own logins. And using that particular provisional number, the assessees were supposed to upload their documents. Yes, we do agree there had been a lot of hassles in the past, because this was for the first time such an exercise was being taken up by the country. Professionals were not geared up in terms of understanding, and it was all an online exercise. There was nothing, not an iota of offline thing which has happened. And accordingly, everybody has had its own experience. The first question which everybody puts up is that what will happen to those assessees who are who failed to, though they have been issued provisional number, but they failed to upload their documents in the on the web portal GSTN. So at the outset, we all have to understand, wherever the department or authorities or anybody who has quoted this migration, they have quoted section 166 of the model GST law. Now, model GST law is something which is still not an enacted law. It is still a draft law. So any section which is basis which is in the model GST law, basis which an action has been initiated, is not having a legal backing. So this particular transition or migration process, whatever has happened, is more of a procedural aspect. It is not a legal aspect which has happened, because 166 says that on the appointed date when the GST law will be enacted, the every existing dealer would be issued a provisional ID and password by the department, and within 6 months he has to upload his documents to the GST department, where GST officers, which have been migrated under section 165 of the model GST law, would be there to examine their documents which have been submitted by the SSCs, and will issue them a final GSTN number. Today, one part of that particular exercise in terms of submission of documents has been very well done by the assessees, and of course the department helping them to submit their document. The first question, if somebody is left, if somebody fails to upload his documents, what will happen? Sir, he will get a complete reasonable opportunity on the appointed day. His provisional ID and number will be given formally to him on the appointed day, and then he has 6 months period as per the model GST law, and he can upload his documents and get a final GSTN number, which will be given by the GST officers of central government and state government after examining their uploads. If there will be some errors or issues in terms of his submission, then definitely that particular shortcoming would be removed by the assessee by rectifying the document. As the experience had been in the past, we have the highest migration happening in Gujarat, 79.15%, followed by Chhattisgarh, 75%, Rajasthan, 72%, Pondicherry, 67.56%. Delhi had a reasonable 54.24% migration happening in this particular period. Assam, on the lower side, the states which had the lowest migration happening in their states were Manipur, Assam, again at 2.88%, Jammu and Kashmir at 0.02%. So there is a lot of drive which is still to happen. The portal for Kerala, Tamil Nadu, Karnataka had opened only on 1st of Jan 2017 for migration, as per the report of the government. And for the central excise assessees who are registered with central excise office, is from 5th of January 2017. Again, for service tax assessee, the drive is starting today, the 14th of Jan 2017. I hope it is 14th for me. So 14th of Jan 2017. And from now till 31st of Jan 2017, they have been given time to migrate it to the new system. It is very also interesting to note that all the new registrations which have happened in the earlier laws, VAT, excise, or services for that matter, which have happened after August 2016. 1st of August 2016 is the date when the new registration they have taken. For all those new registrations, the assessees will get their provisional ID on 1st of February 2017. So this exercise of opening the window and getting obtaining documents is still on, even though the dates have lapsed in many states. But we have seen that the state authorities, VAT authorities, in line with GSTN, has kept their portal live, and they are still accepting the documents from the assessees who have logged in into their system. The drive will continue, and I hope by before the GST is in place, at least most of the dealers, existing assessees, would find that they have already shifted or submitted their document to the GSTN portal. So, some important decisions which have been taken in the last 6 meetings of the GST Council. I have discussed the last meetings of GST Council 5 minutes back. Some important decisions which have been taken. Number one, the threshold limit of the exemption from the levy of GST has been plugged at 20 lakhs for all states and rupees 10 lakh for special category states enumerated in Article 279A of the Constitution. The threshold for availing composition scheme has been fixed at 50 lakhs. However, to our surprise, in the model GST law, which was issued by the GST committee in November 2016, the composition is no longer available to a service provider. So it will be only available to a supplier of goods, not to a supplier of service, which again is, is having some I would say some contentions or some fear on part of small service providers that such benefit is not made available to them, and they would be liable to file 36 returns, 3 months, 3 returns every month. However, a composition dealer is only supposed to file quarterly returns 4 times a year. So that particular benefit they are also looking forward to, so that since their turnover is also less than 50 lakhs, and they are also not making any interstate supply, so they are also wanting that the benefit of such lesser compliance be extended to them. More so in the composition rate and determination of taxes is much required to be easier in cases of services like works contract, dealers, catering operators. All these people, they have been in a habit of paying under composition for since their inception, and they are looking forward that if their turnover is up to 50 lakhs, small service providers, they be allowed to join the composition scheme. Number three, the compensation to the states is again, being discussed between the center and the state, and enhanced compensation is again expected in this coming budget 2017, which is on 1st of February 2017. And again, I think Star is organizing the budget seminar. The date has been confirmed at 4th of February 2017. Uh, so we look forward that in the coming budget, and we have heard that in the budget 2017, some suggestive decisions or some inline decisions would be taken, keeping in mind that GST is round the corner on 1st of April 2017. Approval of draft GST rules on registration, payment, return, refund, invoice, debit, and credit notes have been made by the GST Council, and they have been issued in the public domain for the stakeholders to give comment on such particular uh, uh, draft rules. I think more rules will sooner be in place, but the first thing which we all were looking forward to was a model draft GST law. Yes, we foresee that sooner or later in coming month, we might have a concluded draft model GST law, which have a consensus of both center and states in the GST Council. The band of rate. Now, this is again a very important decision which has happened from GST Council. GST Council has confirmed that there will be four rates which will be there in GST: 5%, 12%, 18%, and 28%. Yes, we do have cesses also beyond 28%. But in terms of other things, these four rates are more or less conclusive. In case goods are to be exempted or they had to be nil rated, 0% would be there. And secondly, there is also expected a special rate for the bullion dealers and jewelers. As we all know, they operate into the range bracket of 2 to 4% in the coming regime. When we say 2 to 4%, it will be half CGST, half SGST, and some of both of them in IGST. So these are some of the major decisions which has been taken in past by the GST Council. We also, I would also like to share one more important piece of information, that assessees, when they have registered already with VAT, and now again they have also obtained service tax registrations in past or excise registration in past, a question has arisen whether do they need to come forward and take the registration again in service tax and excise. That particular one confusion has been clarified by the government, that uh, they do not need to, because they have already initiated their process, and it is, since the GST registration is a PAN based process, for the same PAN, GSTN has issued one single provisional ID and one single password. There will not be a multiple provisional ID and password. And we hope that the assessee, who is a service tax assessee, who has already completed the VAT migration process, he is saved from the hassle of again and again filling the information. But yes, one, two, three things which we all have to keep in mind. Number one, all such assessees should have mentioned their central excise number or the service tax number of that particular state in their VAT registration migration. If they have failed to do, it is still, the window is open. They can log in into their portal and they can amend that particular piece of information. And inline service tax registration will also be migrated automatically into the same GSTN ID. Second thing which we all have to keep in mind is the registration of a taxable person is unique for a state. So when there we are speaking about additional places of business, if I am registered in Delhi, I am registered in Mumbai, the additional places which I have to now put in the migration for Delhi would not include places outside Delhi, because for the purpose of GST, any taxable person who is into different states, so branches of same person, would be deemed to be different taxable person. So when you are a different taxable person, your additional places are only limited to that particular state. It is not all over India. The additional places have to be put in into the GSTN. Now, in line, again, the next problem comes with the centralized registration of service tax assessee. The first question which everybody is looking forward to with full excitement is whether the problem of centralized registration would be sorted out by the service for the service tax assessee. They are in the habit of doing the compliance throughout India at one single place, and it's a big convenience because there's a lot of input or output which cannot be identified. It's a intangible which we are dealing with. There'll be a lot of input services which are coming, a lot of output services which are going, and their domain of identifying the place from where supply is happening, being an intangible, it becomes very tough. So accordingly, the it has been suggested by many taxpayers that centralized option be continued in GST regime also. However, we all have to understand the way the law is. It's a consumption based tax, and taxes to reach the state where the services or goods have been consumed. And accordingly, again, the connecting point between the government and the consumer is the taxpayer. So a taxpayer, wherever he is making a taxable supply from, I'm again using the word from, in such state he need to take registration. So it will not be the place at which supply is made, but from where it is made, which would be liable for registration in the coming regime. So yes, centralized registration is a thing of past. It will no longer be there in the GST regime. Now, what happens to the assessee who are centrally registered today? The assessee there who has a central registration today would be required to obtain multiple registration in the coming time. However, during the transition period, which is the current period, current phase, only one provisional ID is being given to him, and the city or the state where he is registered centrally, he would migrate only that particular registration into the new regime. For all other states, he will be required to take fresh registration, as we understand, in the coming time. And sooner or later, that particular process will initiate only, I hope, once the GST law has been enacted. Because before that, you cannot have a new registration being taken up by the government, or a new registration being granted by the government. So that process will be taken up later. Today, he will be only registering the state where he is centrally registered. All other states will have to wait for him. His new applications will flow on the date when he will be when the GST Act is in place. So this is one big pain area, I would say, for a centrally registered assessee. So I hope we have covered a lot many things today in service tax updates and GST updates, and we will continue to do so in the coming times. I thank you all for this patient hearing, and now hand it over to Sureshji again for further deliberations.
Thank you, Gauravji, for enlightening us on the subjects. First of all, Gauravji has explained the service tax notifications. Thereafter, he has shares his knowledge on the latest judgment announced by the Honorable Supreme Courts relating to service tax in the last few months. Then thereafter, he has touched upon the area of GST and elaborate a complete knowledge about the migration process. Also, he has stated about the GST Council meeting and stated whatever has been decision taken the GST Council meeting has been explained so that we all can learn about whatever has been happening in GST Council meetings. Also, he has stated about the registration process. Also, he has explained about this consolidation of registration under service tax. So he has given us a wide knowledge on the current topics and subjects and the latest update on the indirect taxes. Now we have another speaker, Advocate Jaspal Singh ji, who is enlightening us on the subjects, latest updates on direct taxes. Now over to Jaspal Singh ji.
Good afternoon, friends. Thank you, Suresh, for giving me the opportunity to present the recent updates on income tax, and thank you, Gaurav, for enlightening us on the updates of service tax and GST. Well, with the income tax, things have been very exciting in the last few days. Historic date of 8th of November 2016, when in a sudden move, 85% of the currency in circulation was demonetized. A lot of changes have been incorporated in the Income Tax Act so as to curb the misuse of laws in demonetization. As many as 33 press releases, 23 notifications, and 7 circulars have been issued only by the Central Board of Direct Taxes since the 8th of November. As much as 7 notifications pertain to the amendment of income tax rules. All these communications do not deal with only the effects of demonetization, but majority of them do. Today, I shall touch upon only the important information and changes brought about in the recent past. The first and foremost being, as an after effect of demonetization, large number of people were expected to deposit cash in bank accounts, which also became evident in the first week of the cashless days. And to bring the cash holders to books, a notification was issued on the 15th of November, duly amending Rule 114B of the income tax rules, requiring mandatory quoting of PAN for specified transactions, for specified deposits of cash with banks and post offices, specifically during the 30-day window provided by the government. Hereafter, anyone depositing cash more than 50,000 rupees in a particular day, or 2,50,000 rupees in aggregate between 8th of November and 30th of December, shall be required to quote PAN to the bank, and the banks shall in turn intimate the same to the department under section 114E. At the same time, the department has also clarified that businesses and traders receiving cash in excess of 2 lakh rupees for a single transaction of sale of goods or services are required to report it to the authorities. The provision came into effect with effect from 1st of April 2016. However, there was ambiguity between the understanding of the provision so as to whether the provision applies to a particular transaction or a particular person for number of transactions. A clarification has been provided by the government that the cash received may be in parts, but it applies to a single transaction. Thereby meaning, if a person has sold a goods worth rupees 2,50,000 rupees, and he whether he has received the payment in 5 parts or 2 parts, but the total is more than 2 lakh rupees in cash, he is supposed to intimate the government. But in case there are transactions, there are 5 transactions worth rupees 50,000 rupees, aggregating to more than 2 lakh rupees, the same is not required by law. Another news that spread like wildfire in the November and during December was related to the holding of jewelry. It was rumored that the second step of the government for curbing black money would be sealing of bank lockers, thereby requiring people to come out clean with the contents of the lockers and jewelry in possession. The government, in an attempt to clarify and rule out speculation, issued a press release in December stating that there is no limit on holding of gold jewelry or ornaments, provided that it is acquired from explained sources or is legally inherited. The government also acknowledged some limits, such as 500 grams and 250 grams for a married and unmarried lady, and 100 grams for a male members. However, by no means these are the holding limits. They are only for the purposes in cases of search and seizure, where in case there is a dispute between dispute in relation to the satisfaction of the officer in charge, this quantum of minimum jewelry cannot be touched or seized. Now, moving on, the Honorable Prime Minister, in his speech on the 8th of November, while denotifying the legal status of the old currency, also announced that artisans, workers, housewives would not be questioned for deposit of up to 2,50,000 rupees in bank accounts. This news gained a lot of but the CBDT issued a press release on 18th of November clarifying that this limit of 2,50,000 rupees is in view of the fact that the exemption limit of income tax is 2,50,000 rupees and not otherwise than those limits. However, as a matter of fact, any lady or any person for that matter may claim an amount of deposit in cash in bank to be out of household savings over the years. The cash holding limits may vary from household to household and upon the social or the financial status of that family. In another press release by the CBDT, a stern warning has been issued to the assessees who have tried to misuse the provisions of revising IT returns of the previous years. CBDT has said that those drastically altering the return forms to revise income will face scrutiny and penal action. It was apprehended that a lot of people are going to revise the income tax returns for the previous year specifically in order to generate more cash in hand so that they can explain the same for deposit of cash between 8th of November and 30th of December. The warning from the CBDT is going to act as a deterrent for those intending to do so. Now, at the same time, the income tax department is also going to use big data analytical tool to analyze personal bank accounts so as to segregate black money holders from genuine taxpayers. While the government has used tools to analyze corporate taxpayers in the recent past, shall be used for personal accounts for the first time. Now, this was the view of the department wherein they had taken a very strict view of for curbing the black money. But in contrast, the department's The department is using, and the department has been using all means to identify black money hoarders. The CBDT has also assured small and medium enterprises for reopening of earlier cases due to increased turnover reported during the current year. By means of a circular, the CBDT has advised its officers not to reopen the past assessments just due to the fact that increased turnover has happened in the current year. This is also in line to promote the digital banking and, you can say, the cashless transactions. In addition to this, the CBDT has also come out with a press release stating that the provisions of Section 44 AD of the Income Tax Act, in the case of an eligible business and an eligible assessee, the deemed profit of 8% shall be reduced to 6% in case of digital payments. In such a scenario, the cash receipts and the digital receipts shall be bifurcated, and presumptive taxation shall be levied separately in both the transactions. However, the government is yet to come out with the official notification or legislation in this matter, which is going to happen on the budget date, that is the 1st of February 2017. Now, a second IDS, income declaration scheme, you can say, was released in the form of Pradhan Mantri Garib Kalyan Yojana 2016. A tax was of 49.9% is payable on the amount of declarations which can be made up to 31st of March 2017. Of 25% of the declaration is to be deposited in Pradhan Mantri Garib Kalyan deposit scheme, which will bear no interest and which will be locked for a period of 4 years. A circular is also issued by the CBDT on the 27th of December, giving explanatory notes on the provisions of the taxation and investment regime of the Pradhan Mantri Yojana 2016. It clarifies that the scheme is in respect of any income in the form of cash or deposits. However, it is silent in cases of income in the form of such as immovable property held by the assessors. Now, enough said on the demonetization. I'll try to cover up some of the notifications and circulars which have covered the other issues. A notification was issued on the 2nd of December, laying down the procedures of furnishing Form 26A for removing of defaults and defaults of short deductions and non-deductions of taxes at source. Form 26A is required when a person or a firm or a company fails to deduct taxes at source. This form can be issued at the behest of the chartered accountant, duly certifying certain requirements. This form is now required to be filed in an electronic form. For assessment years 16, 17 and previous years, the form can still be physically filed, or there is an option which has been introduced in wherein it can be filed in the electronic module. But from assessment year 17, 18 and onwards, this form has to be filed in an electronic manner only. The notification number 11/2016 lays down the procedure of filing the form electronically and the procedure of removing of defaults of short deductions and non-deductions of tax at source. There was a scheme introduced in June 2016 regarding direct tax dispute resolution scheme. The Central Board of Direct Taxes has extended the deadline for tax settlement scheme till the 31st of January 2017. The scheme provides an opportunity to the taxpayers who are under litigation to come forward and settle the dispute in accordance with the provisions of the scheme. The provisions of the scheme have been clarified via circular number 33/2016 on 12th of September 2016. Subsequently, there were more queries raised by the various stakeholders. The CBDT, in consideration of those queries, has clarified the same in the form of some questions and answers. Now, I'm only going to share some of the interesting questions that were answered. One of them was, the assessees who have filed writ petitions in courts against the constitutional validity of the retrospective amendment to the Income Tax Act, can those assessees who have filed the writ petitions can make use of this scheme? Now, as per the provisions of Section 2033A of the Finance Act 2016, where the declarations under the scheme is in respect of specified tax and the declarant has filed writ petitions before the High Courts or the Supreme Courts against the order in respect of specified tax, he shall have to withdraw such writ petitions and with the leave, withdraw such petitions with the leave of the court whenever wherever required, and furnish the proof of such withdrawals along with declarations filed with under the scheme. Hence, it is very clear that if the assessee avails the scheme, he cannot contest the constitutional validity of the retrospective amendment in any of the high courts or the Supreme Court. So, by way of this, the government has played very smart and given the opportunity to settle the cases and the writ petitions filed by the assessees also. Now, another question that is answered is where the assessees are at different stages of appeals in different years on similar issues. In such a situation, if an assessee avails the benefits of the scheme for a particular year, where the revenue would whether the revenue would withdraw its appeal against the assessee in those years where the assessee has got relief, in if such is the case, at what stage would the revenue withdraw its appeal? Now, again, it is a very smart move of the government. It says in respect of tax areas, the scheme is available only if the dispute is pending before the Commissioner Appeals. Hence, the question of withdrawals of appeals by the revenue does not arise at all. In respect of specified tax under Section 203(3) of the Finance Act, it states that the declarant, before opting the said scheme, has to withdraw all his pending appeals or writ petitions. The scheme nowhere speaks about withdrawal of any of the appeals by the department. Hence, the question of withdrawal of appeal by the revenue owing owing to the opting of scheme by the assessee does not arise. The other question that is answered is, can the tax payment of under the scheme be allowed to be made in installments as was granted in the income declaration scheme of 2016? Well, the answer to this is also no, since the date of making payment under the scheme is provided in Section 204 of the Finance Act itself. The tax payment under the scheme cannot be allowed to be made in installments. Another question was whether the penalty order under Section 271 or 271 CA would be covered if it is pending before the CIT appeal, would be covered under the scheme. Again, no, because the tax area, the scheme pertains to tax areas in cases of penalty, which is linked to the income total income finally determined. Since penalty order under Section 271C is not linked to the assessment proceedings and income determination, such orders are not covered under the scheme. I'll take one more question out of these questions, which is whether the cases in which consequent upon the search and assessment consequent upon the search, assessments have been completed under 143(3) of the Act, are those cases eligible to avail the scheme? Well, again, the answer is no. The search cases are not eligible. Since the search cases are not eligible for the scheme, an assessment which has completed consequently under Section 143(3), read with the Section 153B, the cases are not eligible to be covered by the scheme. Another very interesting scheme and news which has come up is that the Government of India has signed a joint declaration with the Switzerland for implementation of automatic exchange of information between the two countries. As a result of this signing of agreement, the two countries shall be able to receive financial information held by the Indian residents in Switzerland from 2018 and subsequent years on automatic basis. This news coming up in advance gives a reason for everybody to probably withdraw their monies held in the Swiss banks. Well, I'll now move on to the important cases which have been come up in the recent past and also been notified by the department. The first that I would want to touch upon is pertains to Chapter 6A on account of deductions on enhanced profits. Chapter 6A provides for deductions in respect of certain incomes. Uh, in computing the profit and gains of the business, an assessing officer may make certain disallowances, such as disallowances pertaining to Section 32, 40 IA, 43B, etc. of the Act. The effect of such disallowances increases the profits and gains of the business. The enhanced profits qualifies for a higher deductions eligibility under under Chapter 6A. The department had always contested such higher deduction of allowances. However, the high courts across the country have settled this matter in favor of the assessee. The latest judgment in this case being of the principal CIT Kanpur versus Surya Merchants Limited, IT appeal number 248 of 2015 in the Allahabad High Court. Another is Income Tax Officer 151 versus Cable Constructions Tax Tax appeal number 443 of 2012, Gujarat High Court. Commissioner, another one is Commissioner of Income Tax 4 Nagpur versus Sunil Vishambar Nath Tiwari, Bombay High Court. The department has now issued a circular number 37 oblique 2016 clarifying its stand that such issue is now settled in favor of the assessee, and has also directed its officer to allow enhanced deduction on account of disallowances made under Section 32, 40 AIA, 40 A3, and further instructed not to file any appeals on such matter, uh, and also to withdraw such pending appeals. Similarly, the department has also contested for allowability of deductions under Section 80IB, 80IC, etc., on account of subsidies received by an industrial undertaking. The issue whether such subsidies qualifies for business receipts have been settled by the Supreme Court in the judgment dated 9th of March 2016 in case of Meghalaya Steel Limited in the Meghalaya Steel Limited in 2014. Such view has been accepted by the department, resulting in circular number 39 oblique 2016 advising its officers to allow such claims of the assessee and to settle the litigations pending at various levels. Another issue which the department has clarified and has been a matter of litigation is the expenditure on keyman insurances. The issue related to the admissibility of the expenditure of by a firm on keyman insurance policy in case of a partner has been in litigation. A circular to this effect was issued in the year 1998, stating that the insurance premium paid for keyman insurance is an allowable expenditure. However, if such expenditure is incurred on a partner of a firm, the approach of the officers was to treat such expenditure as not incurred for the purpose of business and would be disallowed. High courts have upheld the admissibility of the expenditure incurred by the firm in cases of partner. The case being Mrs. Ramesh Steele's IT appeal number 437 in the Punjab High Court. The department has accepted the judgment and have not contested the issue any further. Accordingly, the board has also advised its officers to withdraw the appeals at various levels. Coming on to recent judgments, Delhi High Court of the High Court of Allahabad on 3rd of January 2017 in the case of Bharti Swarup and Vinod Kumar Mishra uh, in respect of exemptions under Section 12AA bracket 3 and section 1023 or 80G has held that the word education utilized in section in the section stands independently on its own, and to suggest that the word is confined to rich or to the poor or any strata of the society is not acceptable. The word education had been used in its widest terms and stated that education was something which was the birthright, which is the birthright of every individual. To confine it to the group, to any particular group, would not be fair. Would not be a fair in view of the definition given in section 15 of the IT Act. Now, another very interesting judgment that I would want to share is of Bombay High Court in cases of which pertains to section 260 and 54 EC. Uh, Section 54 EC deals with giving exemptions if the amount of capital gain is invested into bonds. Uh, in the Behest case, investment the agreement of sale of property was entered on 21st of February 2006. Sale took place under the sale deed on the 5th of April 2007. The assessee invested an amount of rupees 50 lakhs from under a sale deed from the advances received from agreement to sale on 2nd of February 2007. The assessing officer as well as the CIT appeals held that the assessee is not entitled to the benefits of section 54 EC as the investments have been made prior to the date of sale of property. Uh, the tribunal the tribunal overruled the CIT appeal and held that because the investments have been made out of the advances received from the sale, the agreement to sell, such investments should be allowed, and the Bombay High Court has acknowledged this judgment very recently on 14th of December 2016. Another very good judgment that has come up is of the Supreme Court of India, which pertains to section 234B. Very interestingly, section 234B pertains to the interest levable. However, this judgment has come up on 29th of November 2016, wherein the Supreme Court has held that in cases of salaries, in case of assessee has received a salary, there is no question of section 234B coming into play, and no interest is livable on such income. Another judgment is of High Court of Madras, which pertains to section 222E, that is deemed dividends. In the particular case, the assessee carries on the business of the real estate development as proprietor under the name of style of Seabros Properties Development. Let's call it CPD, and another of its entity by the name of Seabros Hotels Private Limited. A subcontracting agreement of construction contract was entered into between the two companies in respect of assessment year 2001 and 2. The assessing authorities noted that financials of the two entities revealed amounts of 1.61 crores due from CPD to CHPL, that is the private limited company. Since since CPD was a stakeholder in CHPL, which is a closely held company holding substantial voting rights, and CHPL had accumulated profits over the years, the provisions of section 222E were invoked. The tribunal confirmed in the particular case, the CIT appeal agreed with the view of the assessee, and found that since the transaction pertains to a commercial nature of transaction, Section 222E cannot be invoked. The tribunal confirmed the aforesaid factual findings by the CIT appeal and dismissed the appeal of of the revenue. It held that the provisions of Section 222E imposed deeming fiction and conditions imposed therein, and called for a strict and concurrent satisfaction of all the five things, that is, uh, first and foremost being payment by closely held companies, the nature of payment being in the nature of advances or loans, thirdly being to the payment being made to a shareholder or the beneficial owners of the share, fourth, having to a person having more than 10% of voting rights, and the fifth one being for his individual benefit. In the present case, the credit arises by virtue of contractual obligation and business transaction and had been settled the very next year. There was no individual benefit derived by the assessees. Moreover, credit did not satisfy definition of advances or loans. So, on facts of the present case, the provisions of Section 222E did not stand attracted. I would like to share one more judgment, uh, which is uh, which is of the Supreme Court of India, and again a very recent judgment dated 7th of December 2016. It pertains to capital receipt versus a revenue receipt. The questions were for the assessment years 1999, 2000, and 2001-2. Subventions received by the assessee company from its parent company in Germany in a situation where the assessee company was making losses had been treated to be revenue receipts by the assessing officer. CIT appeal and the tribunal reversed its findings, and the High Court also observed that in such a situation, the receipts cannot be held to be revenue in nature, and allowed the appeal of the assessee. Well, these were the some of the interesting judgments that I could find in the recent past, and the circulars and the notifications that I could share with the August House. With this, I thank Suresh ji for providing me the opportunity to deliberate. Thank you, Suresh ji.
Thank you, Jaspalji, for uh, thank you, Jaspalji, for giving your views on recent notifications under direct taxes. Then you have enlightened us on Pradhan Mantri Garib Kalyan Yojana scheme, direct tax disposal scheme, and the various case law recent in the past on direct taxes. Now, I think all have learned a lot from this webinar. And any query, if any member have, please mail to us on query at the rate taxeducation.in. Thank you all. Thank you, please.